One of the things that's been kind of funny is since I started my own Facebook group, which, if you know me, I'm the least Facebook person on the planet. And so over the last week, it's just been great. I've posted my first comments in my own group, and I'm having to ask people on my team, so how do I reply? How does this whole thing work? But it's been great because the dialogue has been started. And one of the things that I've wanted most is to have a dialogue with my tribe, build a tribe to show people what really works, and have it be more of an interaction conversation of people looking for what really works. And I love my podcasts, and they will not stop. But one thing it's been missing is that interaction, that communication, the ability to clearly show what is and is not working more than just these podcasts. And I love these podcasts. But one of the things that's been going on since I started the Facebook group, I'm also getting ready for my 8-week coaching program that is starting in the new year. And it's just been crazy because my calendars have filled up with having breakthrough strategy conversations with people. And over the last 2 weeks, and this is one of the things I want to share with you, is something that became so clear to me that over the last couple days, I heard it so many times. And you know what? I've probably heard it before, but for some reason, because of the amount of people I have reached out to and connected to at these breakthrough strategy sessions, it became super clear, and it's something I want to share with you. Hey everybody, this is RC Peck, and this is my weekend podcast, and it's so great to have you here. To many of you, if you are if you are Christian, it is a Merry Christmas. If you're Jewish, it's a Happy Hanukkah. If you're pagan, perhaps it's a happy holiday. But I hope for all of you that the end of the year is going great and you can appreciate the things that you do have. But I got this picture because I just think of it as sometimes we think things are safe, right? We think things are safe, but in fact, they're not as safe as we think they are. And the first way I wanted to show this image was to just zoom in on this guy right here and just show him standing there, and not really getting that there's this huge 1,000-foot cliff here, but just showing that if I just kind of carved this out and showed it to you, you'd say, that guy is safe. But what is safety? Like, how do we know we're safe, right? And one of the things that became really clear to me through these breakthrough sessions over the last 2 weeks is we humans use words. And no, that's not the breakthrough. Stick with me. The words we use determine whether we feel safe or not. And so over the last couple of weeks, I've heard from a lot of people who have said, I want to be safe. I want to make sure that 2008 doesn't happen to me again, or 2000 and 2008, or the global financial crisis, or the real estate crisis. Like, what's most important is that I don't sustain those large hits again, because look, my earnings runway is 15 years smaller than it was in the year 2000 when the market fell 50%. It's 8 years smaller, or 9 years smaller when we had the global financial crisis, and I've run out of that earnings runway, and I gotta make sure that things are smart, that I've plugged the leaks, that I've looked for the reasons, and be smart about making sure my money is in a safe place. So what does it mean? Like, how do they know it's in a safe place? And so one of the things that I heard the most from people over the last 2 weeks is say, well, I'm going to keep my money. I'm going to put my money in safe, like large, safe dividend producing stocks, right? Because those are the safe ones. Larger stocks are safer than smaller stocks, right? And they're safe because they've been around 50 or 100 or maybe even 150 years, and they produce a dividend, and they've had a decade-long, multiple decade-long, quarter century, half century, in some cases a century-long history of producing dividends, and they're AAA rated, right? So all the ways that we would tell our brain that we are in safe investments. These are the things you do when you want to have your money in safe. But now look at this. Look at this price chart I'm showing you here. It starts in 2006. It peaks actually before the rest of the stock market peaked, because the rest of the stock market peaked in October of 2007. But the large, safe dividend producing stocks, they peaked in June. June. So what is that, 4 or 5 months before? But this fell. These large, safe dividend producing stocks, they fell. And this fall right here is a 55% fall. There was no safety in large, safe dividend producing stocks. It didn't happen. But people told themselves, or the big box advisors or the conventional advisors said, hey, oh, you want to be safe? Okay, we've got a great way. We've got a system here to keep your money safe. And we're going to give you this 50-page report that has a beautiful laminated cover that's going to show you how we're going to keep your money safe. And we're going to put it in large, established, safe, dividend-producing stocks. Because when our brain hears that, it goes, we're safe. But as you can see here, that actually wasn't safe. And then others may say, okay, RC, but not me. I was in a blended fund. I was in a balanced fund. I was in an income fund. And just, balanced, blended, and income, those words are interchangeable, right? So this fund you're looking at right here, this fund is actually the ticker symbol is actually PRWCX. Not that that really matters, but there's about 270 different positions in this mutual fund. And it's not a teeny fund. This is not $100 million or even $1 billion fund. This fund has $26 billion in it, and it's split down the middle. 50% of the money is in equities, and 50% of the money is in fixed income, is in bonds, right? So one would believe if they went to UBS or Raymond James, Morgan Stanley, fill in the blank with the big box name, they'd say, oh, you want safety? Okay, so what we're going to do is we're going to put you in a balanced fund. Oh, it sounds balanced. We're going to put you in a blended fund. It's blended between bond and stock, and we can do it all with this one fund. Well, look, this fund, you could maybe tell already, but this fund fell 42% during the global financial crisis. 42%. Now, look, it is a smaller fall than the 58% that the stock market did, but I'm willing to bet the people who had their money in this quote-unquote balanced, blended fund, they weren't expecting a 42% loss of their portfolio, because that's not what the brain loads up when they think safety, when they think blended or balanced, right? They think safety. And so what's happened is people have gotten into this trap of thinking of these words that they equate with safety. And maybe this was safe in the 80s and the 90s, but we're not there anymore. And so what I've been seeing over the last couple of weeks is people are saying to me, RC, I know there's going to be another 50% drop. I get it that when we go into recession, the average fall is 35%. Maybe this one will be worse. Maybe it will be not as worse. But given what I'm seeing and what's not being fixed and more debt that's coming in Italy and the U.S. and the president and growth and more debt, it'll probably be a bigger than a 35% correction in the stock market. And so they say, so then what I'm going to do is I'm going to get bonds, or I'm going to get a blended, or I'm going to get a balance. So I'm just going to get those large safe funds. But I want to show you that's not what is safe. And this is why it gets me really concerned. Because think about who owns these quote-unquote safe conservative funds. It's people over the age of 60. Well, people over the age of 60 have already suffered or experienced 2 catastrophic losses, right? And a catastrophic loss can be measured either in the amount of price fall, which was 50%, right? The one in 2000 was a 50% fall. The one in 2008 was a 58% fall. Or it could be a shallower fall, but it takes a very long time to get back to break even, right? So the dot-com fall took 5 years to get back to break even, and the global financial crisis fall took a little over 6 years to get back to break even. Well, when it takes you more than a half a decade just to get back to the starting line of where you were 5 or 6 years ago, that is catastrophic. Not to mention the 50% fall, which is catastrophic to your emotions, and people do have financial PTSD from those. And so what they do is they put their money where they think it's safe. But look, I guarantee you that when we go into the next correction, collapse, whatever you want to call it, when we go into the next recession, people over the age of 60, they're not going to wait around for a 40 or 50% fall that then writes itself back over the next 4 or 5 or 6 years. They're going to get out, which means the places that are the safest, the places that are maybe historically, whatever that means over the last 30 years, are the safest, are probably going to turn out to be the riskiest and more dangerous, especially because the people who own them can't sustain, do not want to suffer through another 50% fall. And so my last price chart is showing you the 10-year Treasury price. This is a price chart. So yield moves in opposite direction. And this price chart is quote unquote only 16 years old. But the bond market in this country has been trending higher for 35 years. So everyone who thinks that bonds are going to be the safe place to be, they've only ever had conversations with their advisors who only ever knew bonds being safe. Well, guess what? If the bond bull market has ended or is ending, then that safe place called bonds isn't going to be safe anymore. And I put a little rectangle up here on the upper right to show you that this is the price of the 10-year bond chopping sideways for the last 6 years. It has been going sideways for 6 years. I mean, it made the fall here, but it went up, it went down, you can see that visually. That is this a topping pattern? Now, the thing is, we don't know until full hindsight, but we do know that bond bull markets last about 30 to 35 years. So we're in that range of them ending, and we do see the actual price of the 10-year treasury going sideways for 6 years. And we do know that when long-term bull markets end or start, they go through longer periods of bottoming and topping. So it's very likely, and I'm not saying it's over, but it's very likely that the bond bull market is putting in a topping pattern, which means when we go into the next recession, it may not be the life boat that people expect it to be, or it was maybe 15 or 20 years ago, because it is topping out, because perhaps inflation is coming back. We don't know these things yet. I'm not going all Harry Dent on you and saying the world is falling or the sky is falling. I'm simply saying, I say world is ending, sky is falling. I'm simply saying, what happens if those safe words like dividend and large cap and long history of dividend producing and bond and blended and income and balanced funds, what if those don't actually mean safe anymore? And yet the people I've been talking to over the last 2 weeks are saying, what I want most, RCA, is to not have to go through a 2008 again, is to go through a 2000, because my earnings runway is either gone or it's much smaller. And what I'm seeing and hearing is they're saying things like blended and balanced and bond, and that concerns me. So what's the takeaway? So first, the takeaway is, how do you spell conservative? Like when you self-describe yourself as conservative, how do you spell it? Do you spell it balanced funds? Yeah? Blended funds? Long-term dividends, dividend growth, AAA rating? Like, how do you define conservative? Because when people say conservative, and I ask them to define it, they say, well, it's a balanced fund, it's a blended fund, it's an income fund, it's dividends, right? It's bonds, it's large cap, those mega cap stocks that are safe, that have been around 100 years. Guys, I don't think it's going to be that way this time. I'm simply saying that because the people who own those are the ones who can't handle or don't want to handle those 50+% corrections anymore, because waiting 6 years, 5 or 6 years to get back to break even doesn't work too well when you're 65. This is not to scare you. I wanted to share with you what's been happening in my world the last 2 weeks of people coming in and saying, hey, I'm looking at what you're putting together. I'm liking the Facebook group. I'll get in there. I've never been into Facebook. Let's get the dialogue going. What does it mean? What does conservative mean to you? How do you spell conservative? And what I'm noticing is the way that people are spelling it is a way that has a very high potential of actually doing the exact opposite to the security and the certainty and the power of their future. And that scares me. It scares me for them. Guys, thank you so much for being in my world. This is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I would love for you to join my Facebook group. I'm posting articles, one, maybe 2 articles a week that really help people get clear about what is working, what can work most for them, the science behind how the brain often works against us. I'm super excited about starting and building this tribe of showing people what really works. So please go back to the email I sent you, use the link to come on into the group. It is open to the public, but we do have to approve you because I don't want any shenanigans in here. I don't want any politics in here. I don't want any trolls in here. I want it to be a clean, kind of safe haven where there isn't the noise that is being hit, where we often are being hit from the outside newsletter, pick of the month newsletter industry and the blogs and the money news channels. So I'm super excited about it. So spread the word. You guys have a great holiday or Christmas or Hanukkah, and I do appreciate you being in my world, and I look forward to connecting with you soon. You guys take care.